Hi, this is Anthony Parent, a tax attorney and partner at Parent & Parent, founder of IRS Medic, and I'm here to talk to you about tax brackets. And the idea here is that where you are in the tax brackets is not what you pay. And the general idea of our tax bracket is the higher your income, the more that you pay. We should stop and ask ourselves why. Why are things set up this way? Well, supposedly for fairness. Well, whose idea of fairness? Who first had this idea of fairness? Well, it was people known as progressive. And these people were around the turn of century, the 1900s, and they had ideas for a great new society. They had wonderful progressive ideas, such as eugenics. They also had forced sterilization and the idea that your intelligence was determined by the shape of your head. And their other genius product was the progressive income tax. Where did they get this idea from? That each according to their ability? Well, likely it was the great philosopher. And the great philosopher, oh, this is who I'm talking about, the great philosopher Karl Marx. Now, I happen not to be such a fan of Mr. Marx because the idea that the more you make, it means the more you pay, doesn't really work. Because in fact, there's plenty of high income people around who really aren't all that wealthy. They have high taxes, high other taxes such as property taxes. They have high mortgage system right now. Their mortgage might be underwater, and they might have a whole bunch of student debt. I'm talking a lot of lawyers and doctors right now, and yes, they might be making a large income, but that money is going out the door. So the idea that the more you make, the more you pay, how it works in the real world, not so well. So at this point, let's go to the tax tables. Let's suppose you are filing single. Well, here we go. Look at this beautiful little tax bracket. So here we go. Your taxable income is over between, let's say, $0 here and $17,400. Well, your tax rate's 10%. Now, that's not very promising. So let's go up to the top here. Let's say you're making $388,350, 35%. Look at that. Wow. Does that mean you pay 35%? Well, yes and no, and actually not at all, because your tax brackets are only your income tax. Filing single, income tax. What do I mean with that? What the tax brackets don't talk about is all the other taxes you pay to the IRS that are based upon your income. Like what? Well, employment taxes. These are Social Security, FICA, and Medicare. Now, your employer, or if you're self-employed, you'll pay that half, but your employer will pay half of it, and you'll be responsible for half. Or if you're self-employed, you'll be paying both halves of it. Now, this is something most people don't understand, that half of what the IRS collects each year from individual is employment taxes, Social Security, FICA, Medicare. So we could say, boy, these tax brackets don't seem all that relevant. And then further, there's other things you need to know. Tax brackets are only for ordinary income. There's totally different tax rates for dividends, long-term gains, and passive income. And then there's this other thing called the alternative minimum tax. Now, the alternative minimum tax was passed in 1969 because Congress found out there's about 180 taxpayers in the United States, and this is true, by the way, this is true, that weren't paying any taxes. And so Congress says, well, that's just not right. We have to come up with a new tax system to make sure that everybody pays something. We have to make sure everybody's miserable. And so the AMT was passed. And seems good because the AMT minimum, right, alternative minimum tax, well, that minimum part sounds good, and geez, yeah, it lowers your tax rate from 26 to 20 or 28%. I'm talking about someone at the top. Here we go, someone who's at the 35%, okay, their AMT rate will go down to 26 or 28%. So that seems like a win. But what happens? The IRS takes away deductions, credits, and some important write-offs. And so really some of the important big ones that we see here in the Northeast, our main office is in Connecticut. is that we see clients who make a bundle of cash in Manhattan, and they get taxed by the city of by the city of New York. They get taxed by the state of New York. They also get taxed by the state of Connecticut. Now, here's the thing: when AMT hits, you're not allowed that as a deduction. It's as if you never paid that, according to the IRS. And so that's just one example of how the AMT does it. But basically, that 26 or 28% AMT tax rate yields more for these guys. So the closing remark is your tax bracket really means little. What you should be paying attention to is your effective tax rate, because what you pay is what matters. Thanks for watching. Stay tuned to this channel for more IRS tax tips from the IRS Medic. Thanks.